Hey everybody, Chuck Gibson from Financial Perspectives here. The last time we talked at the end of January, the top pickers were out once again in force claiming the sky was falling. As it turned out, that was almost a perfect call, but just for the opposite reasons. The U.S. stock markets rallied soon thereafter, and most indices have gone on to close out February at or near all-time highs. If you call a top enough times, you'll eventually be right, but the fact is, no one will actually know a top is in place until much later when you can look back in the rearview mirror and it hits you in the face. Until then, respect the prevailing trend, which is now still up, and if you are nervous, tighten up your stops or lighten up on the size of your positions. Remember, the best way to manage risk is not by guessing tops and bottoms, but rather strictly following a well thought out process that controls losses by proper position sizing and well-defined exit strategies. Okay, I'm going to get off my soapbox now and jump into the charts. As mentioned above, most U.S. markets started out weakly, but rallied closing out the month near all-time highs. This first chart of the S&P 500 is representative of what most areas of the U.S. markets look like. What should be clear from taking the 50,000-foot view of the chart is we're in a strong uptrend. We're well above our support line, and we have all the moving averages bullishly aligned. If I had to find one black mark, it would be the fact that we have negative momentum divergence. This is indicative of an investment in a very strong uptrend, which it's getting tired and it needs to rest. Normally, when the divergences occur, the market will start to consolidate by either declining or moving sideways. So it's important to remember consolidations happen regularly and are absolutely necessary if prices are expected to move higher. Drilling down a bit into the U.S. markets and looking at sector performance in the next chart, you can see that consumer discretionary, technology, and basic materials performed well, all up about 2.5% or more. Utilities, the big loser for the month, were hit hard. Because of their interest rate sensitivity and the fact that bond yields pushed higher over the past 5 to 6 weeks in a counter-trend rally, utilities' February decline should have come at no surprise. In the next chart of the developed world markets, which doesn't include the U.S. stock markets, it found support at the 59-ish level and bounced nicely higher, forming a nice W bottom reversal pattern. If that pattern plays out, the projected upside target would be to break out to new all-time highs above last year's. In January, I was concerned about the possibility of a breakdown below this same 59 level, but instead the market rallied. This is a great illustration of why an investor would want to wait for confirmation before acting. In this case, if you had been early in anticipating the breakdown of that support level and you exited your position, you would have lost out on that 10% gain. Moving along, I'm going to spend a few minutes looking at what I believe were the most noteworthy changes in the market. First, let's take a look at the dollar. The first chart I have of the dollar is a 9-year weekly look showing it breaking out last year from a very long descending wedge. If you follow me, this chart should be nothing new, as I have shown it before. I said at the time, the breakout signaled the potential for a very large, long-term move in the dollar. You can see it rallied very strongly into January while becoming very overbought. As you know, being overbought is a sign of a strong market, but cannot be sustained, so periods of consolidation are needed to unwind that condition. And that's exactly what occurred in February. Narrowing down our view into a 10-month look at the daily chart of the dollar, you can see that area of consolidation we saw on the weekly chart formed a nice bull pennant pattern. Bull pennants are high probability continuation patterns. Price broke out last Thursday with a quick back test on Friday. The bullish case for an ongoing move is supported by the fact that the RSI in the upper pane has stayed above 50 and has curled higher, moving back above its moving average. While not yet crossed, the MACD has curled up and is above its zero line. I do want to mention that quite frequently consolidation areas in steep uptrends often mark halfway patterns. If this is true, the dollar can expect to rise and test the 110 level. Who'd have thunk this mangy mutt would be leading the pack at the Westminster Kennel Show right now? Definitely not me. At the same time the dollar was consolidating, so were bonds. The long bond was massively overbought and needed to rest, which it did, and you can see in my next chart. To put it in perspective, that rest resulted in about a 10% correction, which was painful to live through, but it appears as if the worst may be behind us. Closing out February, we formed a bullish reversal piercing pattern, which, if correct, indicates the correction is over and a resumption of the prior uptrend. Because of this, we added to our clients' long bond positions. To wrap this up, as I'm running out of time, looking at the charts in the context of a bigger picture, it really feels as if we're struggling to not fall back into a deflationary spiral. I say this based on the fact that oil, natural gas, most food items, basic materials, precious metals, and virtually all commodities have just been crushed in their price. Not only do they show lack of strength, but little willingness to move higher. When combined with a strong dollar and U.S. Treasury bond headwind, this is indicative to me of a very strong deflationary forces that are in play. The fact that stocks continue to move higher is the conundrum. During the last deflationary period of 2008-2009, we all know what happened to stocks during that period of time. I can hypothesize on why, but no one, including me, knows why the markets do what they do. I'm bringing this up to let you know I'm very aware and do have a plan in case stocks want to follow in the footsteps of commodities. But until then, I need to reemphasize the fact that the trend is your friend, and as a trend follower, we ride them until they tell us the trend is done. Thanks, as always, for listening, and here's to a profitable March.